Very good afternoon, gentlemen. Hope everyone is having a great Sunday today. Now, one question which is invariably asked by seafarers and NRI is that is filing of return mandatory for them? And if yes, then why? Or in other words, why should they file their returns? There is a general misconception amongst people that if they are non-residents, they are not obliged to file the returns. Now, this is actually not true. Let us see in today's session how it goes. So, filing of returns and especially for the seafarers, the first question that comes is filing of returns mandatory? Now, let us understand the entire concept between the revenue and the taxpayer is like a tug of war. The revenue wants to get the tax out of a taxpayer. The taxpayer wants to, save some amount of tax away from the revenue. So in this tug of war, the taxpayer can only save that much amount what he is legally obliged to do under the provisions of the Act. Now, is filing of returns mandatory? Now, as per Section 139(1), every company, irrespective of income, and any other person other than company, which includes individuals, HUFs, etc. So we are more concerned with this particular portion. If the income exceeds the maximum amount not chargeable to tax, they shall file a return of income. So under this provision, it says that for any individual, if the income is exceeding the maximum not chargeable to tax, then they have to file the return of income. Now, here comes the exception. When it becomes mandatory to file the returns, now this exception stands to the above note that irrespective of whether they are having an income exceeding the maximum not chargeable to tax. Now, what is maximum not chargeable to tax in India? Currently, it is 2,50,000 because after 2,50,000, you need to pay your income taxes. Then, so what is the exception? Now, in this case, even if you do not have an income, you are still under an obligation to file your returns. What is that? First, any resident who at any time holds as a beneficial owner or otherwise any asset located outside India or has signing authority in any account located outside India, this is the fourth provision to Section 139(1), then such individual, even if there is no income, he still has to file his return of income. Now, second, individual HUF AOP, if the total income before deduction under Section 54 and 54G and deduction under Chapter 6A exceeds the maximum amount not chargeable to tax. Now, what it means? It means, see, 54 and 54F, they are sections which are related to capital gain exemption. So let us presume that there is an individual, right? He has earned some money by way of sale of a capital asset, and he has invested that money into either of these sections, which may be between 54 to 54 GB, thereby saving the entire capital gain on his income. Now, tax on such income may be zero, but since the income before deduction under Section 54 to 54 GB and under Chapter 6A, 6A includes all the reduction from 80cc to 80U, they exceeds the maximum amount not chargeable to tax. In that case, even then they have to file their return of income. So let us presume that there is a particular individual. He has a capital asset which he has sold for, let us say, 50 lakh rupees. Out of the 50 lakh rupees, he has invested that money entirely into a tax saving investment which may fall under 54 to 54 GB. So his overall income will be zero. But here it says if the total income before deduction under Section 54 to 54 GB exceeds the maximum amount not chargeable to tax. Similarly, under any other deduction under Chapter 6A. So here, irrespective of the level of income, if before claiming the deduction, the amount is above the maximum amount not chargeable to tax, he has to file his return of income. Now, the third part is very important. If you closely analyze this thing, under the exception, the first rule to exception, it doesn't mention whether it is related to any kind of an income or an expense. It is basically related to a factual point wherein the asset is located outside India or he has a signing of authority located outside India. Under point number 2, it is specifically talking about the income portion. If the income is exceeding maximum amount not chargeable to tax before the deductions under Chapter 6A and 54 to 54G. Now, under the third portion, it says if the aggregate deposits in current account is 1 crore or more, or aggregate expenses of more than 2 lakh rupees of himself or any other for travel to a foreign country, expenditure more than 1 lakh on consumption of electricity, gross receipt in the business receipts if they are more than 60 lakh rupees, gross receipts if they exceeds 10 lakhs in case of a profession, and the aggregate of TDS and TCS during the previous year is 25,000 or more, right? And total deposits in saving bank account is 50 lakh rupees or more in that previous year. In these cases, he still has to file his return of income. So under the third part, it is more concerned about, see, the expense and the receipts, not about the income. So under this particular portion, we are talking more about the expense or more about the receipts. It doesn't talk about the level of income that is being earned. So one of the most important being aggregate expense of 2 lakh or more for any other, himself or any other person on a travel to a foreign country. So this is one of the most common for the non-residents to fulfill. That is an expense of 2 lakh rupees or more. So under these cases, they are still obliged to file their return of income. Now, specifically saying for the NRIs, why should the NRIs file their return? So let us look into this thing in a very conceptual manner. The residential status is based on year-to-year criteria, correct? So it means you may be non-resident this year, you may not be a non-resident the next year, right? So it is always a may or may not situation. Then the fact that the individual is non-resident is only known to him. Now, this is a very true situation which each one of us knows, that if the said individual is fulfilling the conditions as laid down in this act, he fulfills the criteria of being a non-resident, is known to him alone, right? Not even to his professional friend who might be filing his return of income, till the time he conveys or he submits his documents to him. Now, it becomes important to communicate the same to the government. Now, what to communicate? The fact that you are an NRI, the same has to be communicated to the government. Only then the government is going to know that, okay, such and such person is a non-resident and he should be subjected to special provisions of taxation. Third, the tax department identifies transactions on the basis of income and expenditure both, right? We'll keep this for a discussion later as to how this mapping of income and expenditure is done. Because in India, we are identified primarily by our PAN and Aadhaar, right? So for all investment purposes, expenditure purposes, what we are basically submitting, we are invariably being recognized either by our PAN or by our Aadhaar. Now, over the past few years, the Aadhaar has automatically been linked with the PAN, right? And they have to be linked in any case. So, implementation of artificial intelligence and information technology by the government. Scenarios earlier were different. This is something which I am highlighting. Scenarios were Very different in the earlier era because there was a lack of information technology and artificial intelligence into the system. Right. So now all your mapping, all your matching is not being done by an individual. It is being done by way of a computer software, computer system. Right. Now, if you do not file your return, it shall result in a mismatch between the level of income and the amount of expense or the investment that you are making. This mismatch will be reported in the compliance portal, right? And of course, filing of return will always enhance your purchasing power for making the investments and expenses. Now, let us see. We said that we'll talk about this thing later. Transaction on the basis of income and expenditure or both. See, let us try to look at the matching concept as a beam balance, right? This is a beam balance. On one side is your income and on the other side is your expense. In any parameter, your expense should be less than your income. Now, what happens? How do the government get to know what is your income? It can only be known only by way of your filing of return. So let us presume for a gentleman, he makes an investment of 20 lakh rupees in a property. And he has not filed his return of income. So the beam balance in his scenario will be something like this. Against zero income, you have an expense of 20 lakh rupees. Now, from the government's point of view, it basically would seem that this 20 lakh of rupees is something which has escaped tax. Correct? So, this gentleman will get a query from the department that, okay, you have purchased a property or made an investment of such and such amount, whereas as per our records, the income does not match. So this is what is called as a matching concept. The income is matched with the expense. The expenses are matched with the incomes. There has to be a balance between them. It's a golden rule that you can spend only that much amount what you have earned, right? So income tax does not always mean that you're being identified only by way of your income. It is also, imperative to say that you're also identified by the amount of expenditures that you are making. And with every growing day, these transactions and the the reporting entity's obligation to report such transactions is increasing day by day. So all these things are becoming more transparent day by day. Now, should all incomes be reflected even if they are exempt? The answer is yes. All incomes should be reflected. Why? They should be classified into taxable and exempted incomes. Now, under the exempted, all the exempted incomes should be reflected under the exempt income for reporting purposes. You find this head in the income tax forms. So once you're writing this particular thing, you are actually conveying to the government that this is the amount of income which is not chargeable to tax. This affords the depiction of your income earned, whether taxable or not. See, though the government wants tax out of a taxpayer, right? But it is also very lenient in these terms that, okay, if you're reflecting your income, this income may be taxable or this may be exempt. But once you are expressly filing your return that, okay, this is taxable or this is exempt, the government actually gets to know, okay, that this particular gentleman will have a purchasing power at least of this amount. Then, what are the documents that should be maintained? Now, these are some of the common documents, right? Documents that should be maintained. copy of your PAN card, copy of the Aadhaar, ID and password of your income tax return portal. So you should have your ID and password for the return portal. Copy of the passport front and back and including the dates of exit and entry. Copy of the CDC showing the sign on and sign off, your contract letters. The bank statement of all your bank accounts in India and abroad for the period 1st April to 31st of March. Now, in this case, there is just a small exception. Now, for example, there is a particular gentleman who has, done a voyage which ended just on, the last days of March, and his salary is credited in the month of April. In those cases, you should bring in the statement of April as well. Interest certificates from bank. Now, getting the interest certificates from bank is very easy. You just need to, make a request to the bank if you're not having your internet banking. And for a majority of banks who have the internet banking, you can easily download your statements at one go of the entire financial year. Similarly, you should be having the capital gain statements, right? Consolidated reports of capital gain from the CAMS and K FinTech. Housing loan interest and repayment certificates, if any, from the respective authority for those who are availing housing loans. Then you should also maintain the number of house properties, whether they are or commercial properties, singly or jointly, with their rental or the fair value. Also, the detail of sale and purchase of assets, land, building, flats, gold, etc. So if you have made any kind of a sale or a purchase of these, right, then you should have that information in hand. Plus, besides this, if it entails the sale of a particular asset, you should also have a document in, related to that specific asset, related to its purchase also. So, for example, if there is a land which I have sold in the current year, I should also be having the detail of the purchases when I, actually purchase that land. Then, any other income that is received, gifts received during the year. Now, even if you're receiving the gifts on any occasion, be it marriage or otherwise from your, family, or in certain cases from those people who are not related to you, right? You might be having. There are different provisions of the gift receipts. Not all gift receipts are exempted. So if the gift received is exempted, right, you should still show that gift received under the above head, exempt income for reporting purposes. And if the gift falls under the category of being taxable, you should accordingly pay tax on such gift received. Maturity proceeds of any life insurance. Then tax saving under Chapter 6A, which includes your life insurance, health insurance, school fees, donations under Section 80G, etc. and etc. Then year-wise pattern of the dates of exit and entry and the number of days along with the residential status, with the mention of whether the ITR had been filed for that year or not. Then scope of income and residential status. Total income cannot be computed unless we know the residential status. Now, residential status will be determined for every person for each year independently. Residential status can either be resident, deemed to be resident, or non-resident. So there can be three types of residential status. If the individual falls under the category of a resident, then we have to further determine whether such a resident is resident and ordinarily resident, or such a resident is resident but not ordinarily resident. So we continue this particular topic in our next presentation. Thank you.